If you own property or are looking to buy, you're in the path of this shift. The days of bidding wars and waived inspections are over. Sellers are now slashing prices just to get a single showing. From Logan to St. George, inventory is piling up, and the affordability crisis is finally straining the local economy. These numbers aren't a minor cooldown. They point to a deep reset that could erase equity faster than a winter storm shuts a canyon pass. Keep an eye on the city at the top of this list, once the West's golden jewel, now leading the decline. Before we dive in, like, subscribe, and share your observations. Buckle up. Our first stop on this tour of the housing downturn starts now. Number 10. Logan. Head north into the quieter, shadowed stretches of Cache Valley, and you'll notice something unsettling. The remoteness that once gave Logan its small-town charm is starting to feel less like a retreat and more like a financial dead end for homeowners. This is, at its core, a college town built around the university economy, and it's now learning a tough lesson. Student-driven demand can't sustain sky-high home prices indefinitely. What's unfolding here feels eerily familiar, almost identical to the slowdown that hit Fort Collins, Colorado not long ago, a market that seemed stable until it suddenly wasn't. There's a noticeable change in atmosphere. For sale signs that used to disappear within days are now sitting in front yards for months, fading in the sun and enduring the elements. Fresh figures from the Utah Association of Realtors show that unsold housing inventory in the area has jumped by nearly 40% compared to last year, leaving far more homes on the market than local buyers can realistically handle. The median home price, which shot up dramatically during the pandemic buying surge, has started to retreat. Redfin reports that values have fallen by about 8% from their peak, a meaningful drop, not a minor fluctuation. And this isn't just the usual seasonal slowdown. What we're witnessing is buyers pushing back, a clear refusal to accept prices that no longer align with their financial reality. The absorption rate, a metric that estimates how long it would take to sell all current listings at the present pace, has risen past 4 months. That shift quietly signals a move into buyer-friendly territory, even if many sellers haven't accepted it yet. Home builders in the area are feeling the pressure too. Permit data reveals a 25% decline in new single-family construction starts, a strong indication that developers know demand is thinning out. Even more troubling is Cache County's price-to-income ratio. According to Federal Reserve data, the typical home now costs roughly 6 times the average annual income. In a rural economy, that kind of imbalance simply doesn't hold up for long. On top of that, properties are sitting on the market for an average of 52 days, a dramatic shift from the lightning-fast 12-day turnaround we saw just 2 years ago. Nearly 30% of active listings have already reduced their asking prices, underscoring just how disconnected many original price tags were from reality. Number 9. South Jordan. As you move south into the core of the Salt Lake Valley, you land in South Jordan, a city that once symbolized the boom of suburban growth and polished, master-planned communities. For a long stretch, neighborhoods here, particularly around the Daybreak development, were considered some of the most desirable addresses in the entire state, drawing eager buyers almost overnight. But that excitement has slowly soured, and the very features that fueled the surge are now becoming liabilities. The core issue comes down to high density mixed with cookie-cutter housing. When nearly every property on the block shares the same layout and design, and several are listed at the same time, sellers are forced into one primary strategy to stand out: cut the price. What's unfolding looks very much like a supply-driven downturn, where the overwhelming number of homes on the market is simply overpowering buyer demand. The statistics coming out of South Jordan are hard to ignore. Data from Zillow shows that close to 35% of active listings have reduced their asking price, one of the highest markdown rates anywhere in Utah. That essentially means 1 out of every 3 sellers has felt enough pressure to trim their price, sacrificing equity in hopes of securing a deal. Time on market has also shifted dramatically. Compared to last year's pace of about 20 days, homes are now sitting for more than 45 days on average, more than double the wait. Investors who once saw this area as an easy rental play are running into new challenges. Local property management reports suggest vacancy rates have climbed to around 7%, leaving many landlords covering mortgage payments out of pocket each month. Even more concerning is the subtle but noticeable uptick in foreclosure-related activity. Although overall levels remain historically low, early-stage delinquency rates in this area have risen by 12% in just the last quarter. That trend hints at mounting strain, likely fueled by a combination of steep mortgage payments and substantial homeowners association fees that are stretching household budgets thin. Home values are still hovering near the $600,000 mark. But with current interest rates, the monthly cost of ownership has become extremely difficult for the typical Utah family to manage. Meanwhile, newly constructed homes are sitting finished but vacant, prompting builders to roll out aggressive incentives, in some cases offering packages worth up to $30,000, just to get buyers through the door. Number 8. Lehi. As you continue driving along Utah's famed tech corridor, widely branded as Silicon Slopes, you arrive in Lehi, a city that once stood as the state's economic stronghold. For years, Lehi was viewed as untouchable, powered by lucrative tech salaries, aggressive startup growth, and what felt like an endless stream of venture capital. But that foundation has started to crack. The tech sector has been hit hard, and the local housing market is responding with a sharp and unmistakable correction. The once common assumption that tech employees would happily shell out $750,000 for a tightly packed home near the freeway has quickly unraveled. You can sense the momentum shift just by passing the sprawling office campuses, many of which are operating below full capacity, a visible sign that directly mirrors the cooling demand for nearby housing. Recent figures from the Wasatch Front Regional Multiple Listing Service outline a troubling trend. Median sale prices in Lehi have fallen by nearly 10% compared to last year, wiping out significant equity for buyers who entered the market at its peak. Meanwhile, the number of active listings has surged by 55% year over year, as tech professionals dealing with layoffs or relocation mandates rush to put their homes up for sale. The average list-to-sale price ratio has slipped to 97%, which means sellers are typically accepting offers about 3% below their original asking price. And that doesn't even factor in additional incentives like closing cost credits or mortgage rate buydowns. In an unexpected twist, data from Realtor.com reveals that Lehi now ranks among the highest in the state for homes that fall back on the market, with nearly 15% of pending contracts collapsing. In many cases, buyers either fail to secure financing or reconsider at the last minute. Price per square foot has also dropped by around $25, a meaningful decline in a city that once commanded premium valuations as a badge of honor. At the same time, new construction inventory has ballooned to an estimated 10-month supply, leaving major builders sitting on completed homes with limited buyer traffic. Lehi's rapid expansion was fueled by the promise of nonstop growth and prosperity. Now that hiring has slowed and investment has tightened, it's becoming painfully clear that demand can't support the scale of what was built. Number 7. Herriman. As you head farther west toward the foothills, you arrive in Herriman, a community that, in many ways, captures the excesses of rapid suburban expansion and speculative overbuilding. Growth here moved at a pace that far outstripped roads, schools, and basic infrastructure. And now the housing market is dealing with the consequences of that imbalance. Herriman is largely made up of tightly packed townhomes and small-lot, single-family houses, many of which were purchased just 2 years ago by buyers stretching themselves financially to make it work. Today, with property tax assessments climbing and inflation steadily chipping away at household budgets, the area is emerging as a hotspot for distressed property sales. The numbers paint a troubling picture. County filings reveal that notices of default have jumped 18% in the past 6 months alone, a strong sign that many homeowners have hit their financial ceiling. Inventory has surged as well. Redfin reports a 60% increase in available listings compared to last year, and it genuinely feels as though nearly every block has multiple homes up for sale. Sellers aren't just competing with neighbors either. Large-scale new developments are aggressively pricing their brand-new homes below what many residents paid during the 2022 peak, effectively locking existing owners into properties they can't unload without taking a loss. While the median home price has dipped about 7%, that figure doesn't tell the whole story. The real pressure shows up in seller concessions. Data from local title companies indicates that nearly 60% of recent closings involve sellers covering buyers' closing costs, with those concessions averaging around $10,000 per transaction. That's essentially a quiet price reduction, one that doesn't always appear in headline statistics but absolutely impacts net proceeds. Homes are also lingering on the market for close to 60 days now, creating serious strain for sellers who have already relocated and may be juggling two mortgage payments. On the rental side, vacancy rates for single-family homes have climbed to roughly 9%, as many owners who failed to sell have turned into reluctant or accidental landlords. Number 6. Eagle Mountain. If you continue west until neighborhoods thin out and the landscape turns into open stretches of sagebrush and dust, you'll find yourself in Eagle Mountain, a place that truly feels removed from the urban core. This community perfectly represents what's often called a drive-until-you-qualify market, where buyers settle not because they want to, but because it's the only area that fits their budget. And historically, markets built on that dynamic tend to fall first and recover last. During the buying frenzy, people poured into Eagle Mountain simply because it offered the last affordable slice of land within reach. It wasn't about convenience or lifestyle, it was about price. Now, with fluctuating gas prices and return-to-office policies pulling workers back towards centralized job hubs, that long commute has transformed into both a financial burden and a daily emotional drain. What you're seeing is a town that sold itself almost entirely on affordability, and that advantage is quickly slipping away. The stillness here doesn't feel calm anymore. Instead, it feels like a housing market that has stalled out completely. In terms of sheer volume, the slowdown in Eagle Mountain may be one of the most dramatic in the state. Data from the Utah Association of Realtors shows that active listings have surged by 115% compared to the tight inventory levels during the pandemic. That means more than double the number of homes are now sitting on the market, and many of them aren't moving. It's not unusual to drive down entire streets and spot multiple vacant houses, blinds drawn, driveways empty, waiting for buyers who simply aren't showing up. As a result, the median sale price has dropped roughly 14% from its peak, a steep decline that hits recent buyers especially hard. According to CoreLogic, nearly 6% of homeowners in this zip code are now underwater, owing more on their mortgages than their homes are currently worth. In practical terms, they're financially stuck. Inventory levels have ballooned to over 7 months of supply, placing Eagle Mountain firmly in buyer's market territory. The average list-to-sale price ratio has fallen to about 95%, meaning sellers are typically conceding around 5% off their asking price just to finalize a deal. And that's before additional incentives. On top of that, local building permit data shows a staggering 60% drop in new single-family construction approvals, a clear signal that developers recognize demand has dried up. Number 5. Ogden. Looping back north to the historic railroad city tucked against the mountains, you arrive in Ogden, long known as the blue-collar counterpoint to Salt Lake City, where working families could still find relatively affordable housing. For decades, Ogden carried that gritty, industrial identity. But when the recent housing boom took off, investors flooded in aggressively, scooping up aging bungalows, renovating them halfway, and pushing prices to levels local paychecks were never designed to handle. Now the tide has turned. Many of those same investors are unloading properties and stepping away, while longtime residents find themselves priced out. The result is a housing market stuck in a kind of uneasy standstill. You can already see signs of strain: partially completed flip projects sitting idle, and rental signs bleaching in the mountain sun as properties linger without tenants. What makes Ogden's situation especially concerning is who it affects. According to Atom Data Solutions, foreclosure starts in this area have jumped 24%, the highest distress rate among the major cities we've covered so far. This isn't abstract data. It's the working-class squeeze unfolding in real time. Although home prices here remain below the statewide average, the median value has still slipped by about 8% as buyer demand dries up. County deed records show that cash purchases, which were a major force behind Ogden's rapid appreciation, have dropped by roughly 50%. In other words, the deep-pocketed buyers who once drove competition have largely exited. Even more revealing is the surge in listings under $400,000. Inventory in that price range has climbed 60%, which might seem surprising until you factor in current mortgage rates. Even entry-level homes are out of reach for many local households. Time on Market tells the same story. Starter homes that used to sell in about 15 days are now taking closer to 45 days, triple the wait. Redfin reports that around 30% of active listings have reduced their prices, highlighting how sellers are struggling to attract serious interest. Meanwhile, the rent-to-price balance has shifted dramatically. Landlords can no longer rely on rental income to cover today's higher mortgage payments, triggering a wave of investment property sell-offs. Number 4. Provo. Travel south into the center of Utah County and you'll land in Provo, a city anchored by a major university and shaped by a traditionally cautious, investment-minded culture. For a long time, many believed Provo was insulated from serious downturns, almost recession-proof by design. But the surge here was driven by a volatile combination: aggressive student housing speculation layered on top of tech sector spillover, which together sent home prices soaring far beyond historical norms. Now, the cracks are visible, and the market feels fundamentally out of balance. Student demand hasn't disappeared. There will always be renters tied to the university. But the appetite for luxury-priced million-dollar homes in a college-focused city has faded dramatically. What stands out most in Provo is the growing gap between seller expectations and buyer willingness. In this market, that divide may be wider than anywhere else we've discussed. The data reinforces that reality. The Utah County Association of Realtors reports that pending sales in the Provo area have dropped 28% compared to last year. Activity hasn't just slowed, it has stalled. Single-family home prices have adjusted downward by about 10% overall. In neighborhoods closest to the university, where investor speculation once ran hottest, values have fallen closer to 15% as that demand evaporates. Rental property math is also deteriorating. Cap rates have tightened to the point where many multifamily investments no longer pencil out, triggering a 50% surge in multifamily listings hitting the market at once. Mortgage application figures tell an even sharper story. Purchase applications in this specific zip code have fallen by 42%. In practical terms, buyers have stepped back entirely. At the same time, available inventory has climbed 50%, and the absorption rate is approaching 5 months of supply, firmly shifting leverage toward buyers. We're also seeing a noticeable uptick in canceled listings. Many homeowners test the market, receive little to no interest after several months, and ultimately withdraw their properties in frustration. According to Zillow data, roughly 22% of Provo listings are ending in cancellation instead of closing successfully. This is a market grappling with denial, still anchored to peak-era valuations from 2 years ago, while underlying demand continues to erode. Number 3. Orem. Right next door to the university-centered energy of Provo sits Orem, and in many ways the challenges here are just as serious, possibly even more so, because of its dependence on retail commerce and an aging housing base. Orem historically functioned as the county's retail and suburban anchor, a place where shopping centers thrived and families settled into established neighborhoods. But as commercial real estate weakens and storefront vacancies grow, that strain is spilling directly into the residential market. Drive down State Street and the slowdown is hard to ignore. The quieter parking lots and empty spaces create a mood that seems to extend into the surrounding subdivisions. The housing downturn in Orem is largely fueled by a frozen move-up market. Homeowners locked into 3% mortgage rates simply cannot justify upgrading into loans closer to 7%. As a result, the traditional property ladder, starter home to mid-tier to executive, has effectively stalled. The numbers reflect that paralysis. Average days on market have climbed to around 60 days, making Orem one of the slowest-moving markets in the broader metro area. Sellers aren't just waiting, they're stuck. Overall median sale prices have declined by about 9%, but the steepest losses are concentrated in the luxury tier, where values have fallen close to 20%, according to high-end market reports. Upscale homes in Orem are sitting for months, often without a single private showing scheduled, much less a serious offer. Inventory has increased 45% compared to last year, creating a supply backlog that would take nearly 12 months to clear at the current pace of sales. Local multiple listing service data shows the sale-to-list price ratio has slipped to 94%. That translates to sellers accepting roughly 6% below asking price, often sacrificing tens of thousands of dollars in equity. Adding to the concern, the number of homes closing each month has dropped to its lowest level in a decade. Transaction volume isn't just soft, it has collapsed. Perhaps the most telling statistic is the surge in expired listings. Over the past year, the number of properties that completed their listing contracts without selling has quadrupled. Number 2. Heber City. Climbing up the canyon into the mountains, you eventually reach Heber City, a once affordable gateway for those who wanted to live near Utah's elite ski resorts without paying elite prices. For years, it was a haven for regular families, but the pandemic transformed it into the epicenter of the Zoomtown phenomenon. Home values skyrocketed, doubling in a remarkably short span as remote workers chase space and lifestyle. Now, that bubble has burst. The luxury market here is crashing hard, on a scale comparable to Aspen or Vail, exposing how quickly unsustainable appreciation can unwind. The rise in prices was built on shaky foundations, and the correction is coming in fast. According to the Park City Board of Realtors, which tracks the area, median home values in the Heber Valley have dropped nearly 17% from their peak, a dramatic loss in a very short period. High-end inventory has surged alongside this decline. Listings over $1 million are up roughly 80%, with very few buyers left willing to transact at these levels. Luxury homes now linger on the market for more than 90 days on average. Summer listings can easily stretch into winter before seeing serious interest. Construction has ground to a halt as well. Custom home starts have fallen nearly 65%, and the skilled tradespeople who once supported this boom are leaving town as work dries up. Even the wealthy cash buyers who once dominated the market are largely gone. Cash purchases have plunged from 50% to just 18% of sales, leaving sellers increasingly desperate. Price reductions tell the same story. On average, sellers are cutting around $60,000 per listing, the price of a luxury vehicle, and still struggling to attract buyers. Number 1. St. George. Finally, heading all the way south, you reach the red rock landscapes of St. George, a city that now holds the unenviable distinction of experiencing the sharpest housing market correction in Utah. During the pandemic, St. George was the ultimate hotspot. Warm weather, a retirement haven, and a booming vacation rental scene. But that same combination has morphed into a perfect storm for market collapse. The city is now awash in second homes that owners can no longer afford to maintain, alongside vacation rentals sitting empty due to oversupply and tighter regulations. St. George's market is discretionary by nature. Nobody moves here out of necessity, they move here by choice. And at the moment, very few are choosing to buy. The numbers tell a grim story. Washington County's housing inventory has skyrocketed 130% compared to 2 years ago, completely overwhelming demand. Median sales prices have dropped nearly 18%, the steepest decline of any market on our tour. Absorption rates have reached a concerning 8 months, firmly placing St. George into a recessionary housing environment that continues to deteriorate. Meanwhile, AirDNA data shows that vacation rental revenue per available room has fallen 35%, prompting investors to flood the market with properties buyers no longer want. Foreclosure filings are climbing as well, up 30% year over year, as retirees on fixed incomes and investors juggling variable rate debt struggle to stay afloat. Perhaps most striking, nearly 85% of homes are now selling below asking price. Very few sellers are achieving their desired returns. The average days on market have stretched to 65, illustrating just how slow transactions have become. In the span of a few years, St. George has gone from one of the hottest real estate markets in the country to a frozen landscape of declining equity. For anyone who owns property here, the boom is over, and the recovery, or cleanup, could take years. The larger takeaway is clear: Utah is not immune. From Logan's student-heavy neighborhoods to St. George's golf course communities, the housing correction is accelerating statewide.